Hello and welcome to this session on the employment tax and pension provisions included within Finance Bill 2021. My name is Ros Martin. The off-payroll working rules, which prior to the 6th of April 2021 only affected public sector workers, were extended to the private sector with effect from the 6th of April 2021, where the client is a medium or a large entity, unless that client has no UK connection. Now, the main legislation relating to this was included in Finance Bill 2020, but the Finance Bill this year has included some changes. Now, I'm not going to go into these in any great detail because there has been a recent module separately on the off-payroll working rules. Broadly, there has been a slight change to the definition of an intermediary for the purposes of these provisions. There have been changes to way information can move up and down the supply chain, and then there are a couple of targeted anti-avoidance provisions relating to the fraudulent provision of information, but also relating to circumstances where you specifically put in place arrangements designed to avoid the off-payroll working rules. As I say, these are discussed in a separate module. Termination payment provisions. Now, there were significant changes to the way that termination payments were taxed in 2018. Prior to that date, if somebody received a payment in lieu of notice, which was non-contractual, it could be taxed as a termination payment rather than earnings, meaning that it could benefit from the £30,000 exemption which relates to termination payments. It was also free of national insurance contributions. What the 2018 provisions did was introduce the concept of something called post-employment notice pay, or PENP, which is an amount of a non-contractual payment in lieu of notice which would be taxed as earnings rather than as termination pay, and therefore could not benefit from the £30,000 exemption. Very broadly, this is the amount that would have been taxed as earnings if the employment had continued. Finance Bill 2021 has made two amendments to these provisions. The first relates to non-residents. Someone who is not resident in the UK can still be subject to tax on employment income in the UK if any of the duties of their employment are performed in the UK, or indeed if they are earnings from an overseas Crown employment. So just because you're not resident in the UK, if you were doing any work in the UK, it could still be taxed here. The legislation is amended to make it clear that if somebody is subject to tax in the UK, then part of a termination payment can be taxable here as well. So effectively, if your earnings would have been taxable under the normal provisions, then any amount of a termination payment is also taxable. Basically, the percentage of your termination payment that would be calculated is a proportion of it dependent on the number of days that you normally spend working within the UK. So it's fairly logical. The second change we have is to do with an alternative calculation for the post-employment notice pay. Now, PNP is calculated according to a formula where you take the basic pay in the last pay period before the employment ceases, you multiply it by the number of days in the post-employment notice period, i.e. the number of days that you would have had to have worked if you'd worked your notice, and you divide it by the number of days in your last pay period, and then you knock off any amount that's already taxable, and that formula is shown in the notes. Now, you can use up whole months in that calculation rather than days if all of the periods concerned are full months. But actually, if you have a situation where somebody is paid according to months but they have notice period in weeks or days, or they have a post-employment notice period that's not whole months, then you can have a little bit of skewing of the calculation. And so what the legislation is now doing is saying we can use an average month length to calculate the average pay where there is a fixed monthly salary. Now, the easiest way to look at this is to look at an example. So let's just say we've got an employee who receives a £30,000 annual salary paid in equal monthly instalments of £2,500 on the first day of each month. Employment is terminated on the 1st of March. She's entitled to 2 weeks' notice, but she agrees to leave immediately in consideration of a termination payment of £10,000. So what we would have is her normal pay in the last pay period before her employment is terminated is £2,500. We multiply that by 14, which is the number of days of her notice period that she doesn't work, and we divide it by 28 because there are 28 days in February, which is the last period before her employment is terminated. So the PNP is 1,250. So that is the amount of that £10,000 that is subject to tax. If her employment had actually been terminated on the 1st of April, under the old rules, the amount that would be taxable would have been less because there are 31 days in March rather than the 28 days that there are in February. What you do under the new rules is you take the average number of days in a month, which is actually 30.42, and we use that as a calculation, giving a taxable figure of 1,150. So effectively, it's just taking away the variation in the calculation, which depends on the length of the previous month. Although this wasn't strictly in the budget, we might as well cover this here, and that is that the relevant amounts have been announced in relation to van benefit, car fuel multiplier and van fuel multiplier. So van benefit will be £3,500 for 2021-22. The car fuel multiplier is 24,600 and the van fuel benefit is 669, and you can see last year's figures in brackets. What has been included in the finance bill is that from the 6th of April 2021 there will be no benefit associated with the private use of a van which does not have any CO2 emissions. There were a number of employment-linked issues loosely linked with the COVID pandemic, which are included within the finance bill. The first is in relation to the provision of home office equipment. So if an employee has been provided with equipment to enable them to work from home, then it had been previously announced that there would be no charge for this in the 2021 tax year, and that is now extended to cover 21-22 as well. Secondly, there is confirmation that there will be no income tax charge arising in 2021-22 where an employer provides coronavirus tests. These are antigen tests, not antibody tests, though I think antibody tests are going to become less common now because of the vaccination. And also, the exemption is extended to cover situations where an employee pays for the test and they are reimbursed by their employer, and that will cover both tax years as well. The next one is in relation to EMI, Enterprise Management Incentive Options. An employee who's provided with options under EMI has got to meet a working time requirement. They've got to spend at least 25 hours a week, or if less, 75% of their working time working for that employer. And if they cease to meet that requirement, that would be a disqualifying event and the tax advantages of the option would be lost. Now, what the legislation does is it modifies the provisions such that if somebody is not working because they're either furloughed or on unpaid leave due to COVID, and therefore they are not working the sufficient number of hours, then that will not be treated as a disqualifying event if it happens on or after the 19th of March 2020 and before the 5th of April 2022. And that will apply regardless of when the share options were taken out. And then finally, cycle to work schemes allow a tax exemption where there is provision of either a bicycle or safety equipment by an employer to encourage employees to cycle to work. Now, one of the conditions is that the equipment must be used mainly for cycling to or from work or in the course of doing work. Now, obviously, people may not have been going into work during the pandemic. And so again, for schemes entered into before the 20th of December 2020, there is a relaxation of this condition which runs through to the 5th of April 2022. But obviously, anyone who's providing bicycles under this scheme, where there is a permanent move away from the office, will need to be careful once we get past the 5th of April 2022. The next provision is a very, very small amendment to the optional remuneration provisions or salary sacrifice provisions that were introduced in 2017. This legislation removed the benefit of entering into salary sacrifice arrangements, but certain long-term benefits, such as the provision of living accommodation or school fees, were allowed to continue until the 6th of April 2021. However, the tax advantages of those could only continue as long as there was no variation in the employment contract. There were, however, a list of statutory payments which could be disregarded for the purposes of determining if there had been any contractual changes in relation to employees, but that list didn't include statutory parental bereavement pay because that only came into being in April 2020, but the legislation has now been updated. Couple of issues to do with pensions. There is a new type of pension scheme is going to become available from this year, which is something called a collective money purchase scheme, which is a new kind of employer provided scheme, and the legislation has been amended to make it clear that this would be treated as a registered pension scheme. And the other point to note is the pension lifetime allowance is being frozen at £1,073,100 until April 2026, along with, of course, very many other limits. Final thing to talk about is the construction industry scheme. There are a number of amendments to this. There is a change in the definition of what constitutes a deemed contractor. Previously, the limit was in any 3-year period a person has had average annual expenditure of more than £1 million per year, and you always looked at the 12 months to the 31st of March each year. The new test will be that a person will be a deemed contractor if their expenditure exceeds £3 million in the previous year, with the test being applied retrospectively from any given point in time rather than just at the 31st of March. So there is a new point at which you can become a deemed contractor. The next point relates to the allocation of value to materials when looking at the deduction of tax for payments to subcontractors. Previously, the legislation said that you could deduct the amount of any direct cost to any other person, but now it is going to be amended to the direct cost to the subcontractor. So basically now you will only be able to deduct amounts which have specifically been incurred by the subcontractor. There will also be a new possibility that HMRC will be able to restrict deductions claimed apparently for tax deducted at source by a subcontractor if HMRC do not believe that actually an amount has been deducted. So it's a new power to any officer of HMRC to amend deductions claimed either through RTI or as offset against income tax if you are an unincorporated business. And finally, there is an extension of the scope of the penalty regime where a person supplies false information relating to a gross payment status application. And the maximum penalty under those provisions would be £3,000. Okay, that brings us to the end of this module. Thank you for your time and goodbye.